This is Brandon from the Chinchilla Picking Podcast. Dave is normally with me. As you know, we normally do a full 40 to 50 minute show weekly. But we've committed to each other that one week I will do a break show that goes 10, maybe 15 minutes. Something that you can listen to maybe on your break from work or on your drive to work. And then on the next week, he'll do one. And the week after that, I'll do one. So you'll be getting a little bit more content from us. And for this episode, I thought it would be very important to talk about Howard Marks's recent memo called Selling Out. Now, Howard Marks is co-founder of Oaktree Investments, and he's been writing these kind of memos for the better part of about 4 decades, and they're very worth a read for any investor. They are easy to digest, they're quick, they're full of insight that he's built up over his 40-plus year career. And I just recommend anybody going back and read as many of these things as you can, because you will get as much insight as anybody has from these things. He also, a few years ago, put together most of his works, most of his memos, and he put them into a book called The Most Important Thing. I recommend reading that as well. Once again, he's a fantastic investor, fantastic author, and he's really good at putting his insight and his thoughts together in entertaining and educational ways. So what I want to do is I want to talk about summarizing this memo, and in between I'll give you my thoughts on what's said here, and we can kind of dive into it a little bit more. Because this week, not only do we have the Federal Reserve raising rates upwards of maybe even 7 times this year. That's going against us. There's headwinds with that. Now there's headwinds with Ukraine. In the future, there may be more headwinds with China and Taiwan. So these are all things that you need to have on your radar as an investor. But sometimes it pays better to do nothing. It's ingrained in us that action is good. But sometimes in the market, and in fact oftentimes, really most of the time, action, especially when it's based on emotion or when it's based, whether that emotion's greed or whether it's fear, it will work against us. So if you've invested in a stock because of irrational conviction, sometimes it's just better to hold that stock rather than trade around it. So let's get into this. Howard Marks Selling Out. This is about why traders sell stocks and why oftentimes it wasn't a good idea to do so. So he starts with, few things that are important can be distilled into just 4 words. Thus, buy low, sell high is nothing but a starting point for discussion of a very complex process. So the meaning behind that, and sort of what he gets further into in this article, is that yes, buy low, sell high. The lower you buy a stock, the greater your returns are going to be in the future. But the nuance here is that most people, most of the time, do not catch the exact bottom. And one of the reasons why people fear when they own a stock is that they fear they bought it too high. Now, if you bought a great company with a relatively low valuation, or even maybe that valuation is a little bit higher, but it'll grow into it. If you're scared that you bought too high, oftentimes all you just need is a little bit of patience. Maybe you even cost average down. You take the dips as an opportunity to lower your cost. If you've a rational conviction with that stock, this Ukraine situation should have no effect on that rational conviction. If you bought Apple because even though it's a $2 trillion market cap stock right now, it's got a relatively reasonable price to earnings ratio. They've got incredible cash flow. They've got tons of money. I think $98 billion chilling, just sitting there waiting for them to invest into something else and make some other new innovation. This Ukraine crisis shouldn't have caused you to sell Apple. It shouldn't have caused you to freak out and sell. So be more rational with your investments here. And sometimes if you bought Apple in the 170s, yes, you may have been looking at the all-time highs, but it's going to grow into those valuations. And over the long term, even if it takes you a year to get back there, maybe it'll take less to get back there if you cost average down with Apple. It just literally, it bounced. Let me make it a side note. Apple bounced off the 200-day moving average this week. And I've said it quite a few times on this podcast that Apple, what it likes to do is it likes to have support at the 100, and then 150, and then 200-day moving average. Rarely ever goes below that. You buy it at that 200-day moving average. I've done this multiple times over the years. I've never had an unsuccessful trade on Apple doing this. Those moving averages are very important with a lot of stocks. They're especially important to Apple, and it did it again this week. It bounced off that 200-day moving average, and it started coming right back up. Anyways, with that being said, yes, maybe you bought a stock too high, but if you've got a great company and you've got rational conviction for whatever reason you bought it, and if that reason's still holding, you use the dip to buy. That's what this is. This is nothing more than an opportunity when it comes to the Ukraine crisis. Now, we can look at the Federal Reserve, the 7 rate hikes. That adds more uncertainty, of course, to the market and the revaluations. But these companies that have that much cash on hand and have positive earnings and have already grown into those valuations, those shouldn't get hit as hard. And when they do, you use it as an opportunity to buy more. Companies like Apple that just stack the cash. Companies like Microsoft that just stack the cash. Inflation will actually work better for them than it does for most other companies, because what inflation does, yes, it devalues the currency, but that will actually just mean that Apple's going to have more of it. And Microsoft will have more of the dollar. So you're a little bit more of a safe investment with those kind of companies, along with when you're talking about inflation, along with consumer staples, which I've been talking about for a few months as well. Now, Jim Cramer's got on record now in the past week, and he's been telling you to not buy companies that have negative earnings. He's correct about that. I've been saying it on this show for the past 3 months. Don't buy companies that have negative earnings. Now, if you do have a company that has negative earnings right now, if you've invested in it, you may be stuck in it. And the only reason I would say to sell, if you've already bought it, is if your reasoning has changed. Now, hopefully you bought this company because you expected positive earnings. You expected it to grow into its valuation. If that's not going to happen, you need to get out of it, because your conviction shouldn't stay at the same level as it was before. Your thesis has been proven wrong. So there are times to sell, right? All right, let's get back into this. People often accept unquestionably that they should sell appreciated assets just because they've appreciated in value. Now, he talks about a 2015 memo that he wrote where he said this: when you find an investment with the potential to compound over a long period, one of the hardest things is to be patient and maintain your position as long as doing so is warranted based on the perspective, return, and risk. Investors can easily be moved to sell by news, like Ukraine, emotion, and usually emotion you're selling either because it's up, like you just said, or because it's down and you're freaking out and you're afraid you're going to lose it all. Another reason would be the fact that they've made a lot of money today, or the excitement of a new, seemingly more promising idea. When you look at the chart for something that's gone up and to the right for 20 years, think about all the times a holder would have had to convince himself to not sell. So think about if somebody bought Amazon in 2002, for example. Now, you could say if you bought Amazon in 2002, by today, you'd be doing well. You may even be a rich man. But most investors would have sold Amazon a long time ago and missed out on 75 to 80% of those gains. And actually, he talks about this. He says everyone wishes they bought Amazon at $5, and he says 1998 here. So everyone wishes they bought Amazon at $5 on the first day of 1998. Since it's now up 660 times. Actually, it's up more than that now. But who would have continued to hold the stock once it hit $85 in 1999 and made 17 times in less than 2 years? Who among those would have held on to have been able to avoid panicking in 2001 as the price fell 93%? And who would have just sold by late 2015 when it hit $600 up 100 times from that 2001 low? Yet anyone who sold at $600 captured only the first 18% of the overall rise from that low. So you see what he's saying here. Most investors sell too early and for not rational reasons. Most investors trade too much around their own to their own detriment. This involves panic selling securities because they've dropped, panic buying securities because they've dropped, and you want to cost average down. That could be a panic as well, right? Like if your conviction, if your thesis has been proven wrong and there's a reason why the stock is moving down that you didn't expect, and instead of selling it, which at that point, once your thesis is proven wrong, then yes, you should sell. Then you've become prideful, which is a poisonous emotion to an investor as well. And then now you're just buying because you hope it'll go back up. Selling a portion of your stake because you believe a temporary drop is coming is often a mistake as well. If you're buying for the long term, if you're investing and you're going to hold on for 10 years, 20 years, whatever, a temporary drop should be of no matter to you. And oftentimes you'll buy an undervalued stock and you have a thesis. Like I've done this before where I've bought an undervalued stock and I thought this will probably reach valuation in 2 years. Lockheed Martin actually comes to mind. I was expecting next year. I was expecting that next year it would become fairly valued. 2 months and 20% later, it's at a fair valuation right now because of the Ukraine crisis pulling a lot of gains for that stock forward, right? So the point is you may believe a temporary drop is coming. If you've bought an undervalued stock, oftentimes there's no telling when that stock will shoot up to becoming valued. So I think you should just hold your position until you get what you expect to get. Or, even better, until the company evolves to the point where you expect it will evolve. And if it's continuing to evolve and continuing to grow, then you should just hold it. Now, another irrational reason to sell, well, I shouldn't say irrational, I should say invalid. It's an invalid reason to sell, is selling only because a stock is up. A good deal of selling, he says, takes place because people like the fact that their assets show gains and they're afraid those profits will go away. Now, he's not saying that investors shouldn't sell appreciated assets and realize profits, but it certainly doesn't make any sense to sell things only because they're up. They oftentimes are up because they deserve to be up. You shouldn't sell, Amazon. You shouldn't have sold it in, I think he gave, what was that example? In 2015. There was no good real reason to sell Amazon in 2015. Now you made a good, if you made good profits on it, that's fine. But there was certainly good reason to continue to hold Amazon in 2015 as it continued to grow. You can see these things in the balance sheets and the financial statements of the company. If the financials aren't deteriorating, and there's no evidence that it's, that the financials are topping of the company, then why would you sell? That makes no sense. To sell only because it's up is an invalid reason. Now, there is a good time to sell. But it largely depends on A, whether the fundamentals are playing out as you hope, and B, how this opportunity compares to the others that are available, taking into account a high level of comfort with the stock that you've already owned, right? This was from the article as well. So the point that he's making here is that, yes, you could sell a stock and realize the gains for it, take the gains, lock them up, but you're not taking gains off the table. Don't think that way. If you're selling a stock, oftentimes you should look at it and say, is there another stock that I can put my money in that has a better opportunity than the one that I already own does? Because most investors are going to sell and then reinvest. So if you're only selling a stock because it's up 20%, then you may turn around and buy another stock that loses you 15 of it or more. So the idea of realized gains, it's not like you're just, you're selling the stock, taking the money out of your portfolio, putting it in the bank and never reinvesting it again. That wouldn't be advisable either. Most people are going to reinvest. So if you're going to sell a stock, then do you have a better opportunity that you see that you could buy into and make more money with, that will compound better than the stock that you own will? If you do, that's fine. That's great. But if you don't, I would strongly consider holding that stock. Here's the bottom line, he says. We should base our investment decisions on our estimates of each asset's potential. We shouldn't sell because the price has risen and the position has swelled. There can be legitimate reasons to limit the size of the positions we hold, like diversification, for example, but there's no way to scientifically calculate those limits or what they should be. In other words, the decision to trim positions or to sell out entirely comes down to judgment, like everything else that matters in investing. That's kind of a scary prospect for some investors, that oftentimes valuations and the ratios that we use and all of that, they're subject to judgment. 100% subject to judgment. But it's true. So you kind of have to keep in mind the psychology of the market, what makes people tick, right? And when people are selling because they've made a profit, or they're selling because it's down, that's the best opportunity for you, is to buy it. Especially if somebody's selling something only because it's down, you're catching somebody else's falling knife. And that is the best position to be in long term. He goes on. What's clear to me is that simply being invested is by far the most important thing. And then he said someone should write a book with that title. That's because he wrote that book with that title. Most actively managed portfolios won't outperform the market as a result of manipulation of portfolio weightings or buying and selling for purposes of market timing. You can try to add to returns by engaging in such things, but these actions are unlikely to work at best and can get in the way at worst. So I want you to keep this article and this podcast in mind as we're going through the interruptions of the market that are happening this year and will probably continue to unfold this year. And if you have some cash aside and you find some opportunities, put it to work. And you'll be in a lot better of a spot than most people. Put yourself in a position where you can catch somebody else's falling knife and you can take advantage of the irrationality of the market. That's all I have, and I will see you most likely on Tuesday. I think on Tuesday we'll probably do our next show. I I recently started a new job that I really like, and unfortunately, the hours are a little bit crazy. They're unpredictable, and so it's kind of gotten in the way of us doing a regular show every week. But we have been doing a show every week. It's just been on different days, and for that I apologize. But to combat that, the best way to combat that is to hit that subscribe button. So we may not be doing a show every Tuesday. For a particular week, it may fall on a Wednesday, it may fall on a Thursday, it may even fall on a Friday. But if you hit that subscribe button, you will be notified every time we put out a show, no matter when it is. Have a good night.